Welcome back to the Deep Dive, where we take that fire hose of source material you've provided and really distill it into pure, actionable insight.
It's great to be here.
Our mission today is, I think, absolutely critical for anyone tracking the modern digital economy. We're taking a massive, thorough dive into AppLovin Corporation.
That's right.
And this is a narrative that really has everything. I mean, it encompasses extreme growth, some incredibly aggressive M&A, a total strategic overhaul, and, that inevitable confrontation with financial and regulatory scrutiny that just seems to define big tech today.
It really does. And when you look at AppLovin, you are looking at one of the great accelerants of the entire mobile economy.
Accelerants, that's a good word for it.
Yeah, they're an American mobile technology company.
Yeah.
Based in Palo Alto, California, and they were founded way back in 2012.
And crucially, I think they've often avoided the consumer spotlight, haven't they? But their technological footprint is just, it's everywhere.
It's everywhere. If you've played a free mobile game or if you've seen an app scale from nothing to millions of users overnight, there's a very good chance AppLovin was the kind of invisible infrastructure making all of that happen.
Okay, so let's unpack this dual identity they had for so long, because it really defines their whole trajectory until this very recent pivot. What exactly is their core business? What were the main tools that allowed them to get to such a staggering scale?
Well, their core business is essentially serving the entire mobile developer ecosystem.
Mm-hmm.
They basically act as the central nervous system for mobile advertising and monetization.
The central nervous system.
They help developers market their apps, monetize them, analyze the data, and publish them. And this is all done through their very sophisticated technology stack.
Which revolves around a few key platforms, right?
Mm-hmm.
I'm seeing Max, App Discovery.
Exactly. Max is the big one. That handles the monetization piece. Then you have App Discovery, which is all about user acquisition, finding new people for your app. And then there's Spark Labs.
What's Spark Labs?
Spark Labs, in essence, operates as an incubator. It's also a strategic investment arm that helps them stay ahead of the market curve by, testing new ideas internally before anyone else.
And the hook here, the reason this story really demands a deep dive, is this incredible contrast. I mean, we're tracking a company that operated in full stealth mode for years.
A classic Silicon Valley ghost story.
It really is. And they go from that to achieving an astronomical, what was it, a $123 billion valuation by 2025?
$123 billion? It's hard to even wrap your head around that number.
And it culminates in this prestigious place on the S&P 500 index. Yet, and this is the key, they achieved this apex while simultaneously facing serious high-stakes regulatory scrutiny, specifically an SEC probe into the very data collection practices that fuel their empire.
Right.
It's just the ultimate case study of velocity meeting the regulatory wall.
It is. This journey, it perfectly illustrates not just the speed of modern digital advertising wealth, but also the immense political and legal friction that wealth creates when it's built on massive scale user data. The stakes could not be higher for AppLovin or, frankly, for the future of ad tech globally.
Okay, let's rewind then. Let's go back to the genesis, 2012. It's a moment when the mobile app market is just beginning its absolute explosion.
Yeah.
What was the origin story? Who were the foundational players? And why did they choose to operate in the shadows for so long?
So AppLovin was established by three co-founders, Adam Faruqi, John Kristanak, and Andrew Karam.
All right.
And the core idea was really ambitious. They wanted to build a single, highly efficient engine that could optimize both user acquisition and monetization across what was, at the time, a rapidly fragmenting mobile landscape.
So they were trying to solve the biggest problem facing every single developer.
The biggest problem, getting paid and finding users. I'm doing it at scale.
And before we get into the nuts and bolts of the strategy, there's this small but persistent piece of startup lore we found in the sources about the company name. I think it's a necessary correction for the record.
Oh, absolutely. The name AppLovin, you hear it all the time. It gets linked to the character McLovin from the movie Superbad.
Right, the cult classic.
And that rumor has just stubbornly persisted in tech circles for years. However, the CEO, Adam Faruqi, he explicitly clarified that the name was actually inspired by a company called BlogLovin.
BlogLovin, the content organizing company.
That's the one. It's a great reminder that even these massive successful companies often have to, correct the invented folklore that just kind of grows up around them during those early quiet years.
Speaking of quiet years, that decision to operate in full stealth mode until 2014 is highly unusual, especially in a field as dynamic as mobile advertising. What was the strategic benefit of staying hidden for those first 2 years?
In that era, 2 years in mobile tech felt like a decade. The strategy was likely twofold. First, it allowed them to build and iterate on their core technology stack, perfecting their algorithms, their data ingestion pipeline, without competitors being able to just easily copy their
So
methods,
they were building the engine in secret.
building the engine in secret. And second, and this is crucial, it meant they could secure significant high-profile customers based purely on performance, not on public perception or marketing hype.
And they were successful in that crucial early capital stage. How much did they manage to secure, and where did that funding come from?
They secured a pretty modest $4 million dollars in initial financing,
Only 4 million.
just 4 million, and it came from a diverse group of sources, which really reflects a high confidence in their technology, even without a public profile. We're talking angel investors, Streamline Ventures, and the Web Investment Network.
It's what they did with that 4 million that's so remarkable.
Exactly. They achieved this really impressive traction right out of the gate.
And who were some of those established brands that were trusting this ghost company with their precious user acquisition budget before AppLov even launched publicly?
Well, the sources mentioned some really high-traffic digital brands like OpenTable and Spotify.
Wow, okay. So big names.
Really big names. And the fact that sophisticated data-driven companies of that stature were already relying on AppLovin's platform, it just demonstrates that the efficiency they were building during that stealth period was immediately applicable. It was effective for monetization and user acquisition at a massive scale. It validated their core engine instantly.
So once they do emerge publicly in 2014, their first visible move wasn't about organic growth. It was about consolidation.
Exactly. They signaled their aggressive intent right away. In October of 2014, their initial expansion was the purchase of Moboko, which was a German mobile ad network.
A German one, so they're thinking international from day one.
It was a tactical acquisition. It immediately expanded their geographical footprint into the very lucrative European market, and it gave them a technological boost. It showed they were playing a global game right from the very start.
This successful early trajectory leads us directly to the mid-decade, when they run headfirst into a wall. And it's not a business wall, it's a wall of international politics.
This is where the story pivots so sharply, and it demonstrates the geopolitical sensitivities that are just inherent in owning massive amounts of U.S. user data.
Right.
So in 2016, AppLovin reportedly entered an agreement to be acquired by a Chinese private equity firm, Orient Hontai Capital, for a staggering $1.42 billion.
$1.42 billion. That is an immense valuation for a 4-year-old company. It really shows the market recognized the critical nature of their data platform. But the deal, it never closed. Why?
It was abandoned, and it was due to strong, clear opposition from CFI-US.
CFI-US, the Committee on Foreign Investment in the United States.
Exactly. CFI-US has the authority to investigate any mergers and acquisitions that could pose a risk to U.S. national security. And the concern here was likely centered on the very sensitive nature of AppLovin's technology stack.
Because it's a platform that collects and processes huge quantities of data on U.S. consumers.
Vast quantities, and it manages the advertising spend of countless U.S. app developers. So allowing a foreign entity, particularly one linked to China, to control that level of digital infrastructure it was deemed too great a risk.
So the acquisition was blocked. But they didn't just walk away, did they? How did they salvage the relationship and, more importantly, the capital?
They executed a masterful pivot. They transformed the acquisition agreement into a debt investment instead.
So not equity, but debt.
Exactly. This maneuver allowed Orient Hontai to still deploy their capital, but it fundamentally stripped them of any control or ownership of the strategic U.S. asset.
And the implication of that is huge.
It's a crucial implication. It showcased this early geopolitical resistance in the sector, and it forced AppLovin to maintain control over its own U.S. data infrastructure. Orient Hontai did retain a small equity stake, basically a debt-based residual interest, but the threat to national security in the eyes of CFI-US was mitigated.
And despite that CFI-US roadblock, their growth trajectory was just It was undeniable.
Absolutely. The external validation just kept piling up. They were recognized on the Deloitte Fast 500 North America list in 2016, where they ranked number 10, and then they repeated that recognition in 2018.
And Adam Faroohi, the CEO, he was getting noticed too.
He was. He was honored on the 2017 San Francisco Business Times 40 Under 40 list.
Yeah.
This just proves their growth was explosive and recognized by the financial and business community, even as they were navigating these really complex international politics.
So by 2018, having successfully navigated the CFI US block, U.S. institutional investors were finally ready to step in and permanently replace that refinanced Chinese debt.
That's the classic pattern, isn't it? Validating a high-growth tech asset. In August of 2018, the private equity titan KKR & Co., Inc. acquired a minority stake for $400 million.
$400 million. And that set a new valuation, right?
It did. This specific investment immediately valued AppLovin at $2 billion. And this was a major inflection point. It provided significant institutional confidence from major U.S. financial players. It officially validated their technology and their growth potential.
And let them clean up their books.
It let them fully refinance that convertible note facility from Orient Hontai Capital in the very same month, closing that geopolitical chapter entirely.
So we exit this foundational phase in 2018 with a $2 billion valuation, a clean capital structure, and a very deep understanding of the regulatory friction inherent in their field. That just perfectly sets the stage for the next phase. Massive, massive expansion.
Yeah, that $2 billion valuation and the KKR capital injection, it signaled that the company was ready to dramatically accelerate its strategy.
And this acceleration was defined by this massive, dual-pronged strategy. They wanted to become a major mobile game publisher, while at the same time acquiring and consolidating the most powerful monetization tools available to all developers.
That's the perfect summary.
Okay, let's start with the gaming footprint, because that's what created their unique hybrid business model for the next few years.
The sources highlight the launch of Lion Studios in 2018. What was that?
Lion Studios was so much more than just a new publishing label. It was launched in July 2018, and it was a dedicated publishing division created to work with external mobile developers to promote and publish their games.
So strategically, this was brilliant.
It was brilliant. It officially cemented AppLovin as both a software provider, the plumbing, and a content creator, the product that's flowing through the pipes.
Which gave them this unique proprietary insight into the entire mobile supply and demand chain.
The whole thing. They could see everything.
And this wasn't a slow build, was it? It was a rapid, heavy investment spree that just continued through 2019 and 2020. The goal was market scale and data acquisition. That was it. In 2019, they invested in PeopleFun, who are known for word games. They invested in Firecraft Studios and Belka Games. They were just rapidly building this diversified portfolio.
And the momentum continued.
It did. In 2020, investments in Jiwa and Redemption Games, which all culminated in the major headline-grabbing acquisition of Machine Zone, or MZ.
MZ. Now, they were a true industry heavyweight. Why was that acquisition such a power move in the mobile gaming world at that time?
Well, MZ was famous for games like Game of War and Mobile Strike. They were known for pioneering these really high-spending in-app purchase models.
So acquiring MZ wasn't just about revenue.
Not at all. It was about acquiring sophisticated operational knowledge. It was about getting data on high-value users and the ability to test and stress test their own ad technology Max and app discovery on their own massive, highly profitable games.
Bringing MZ under the AppLovin umbrella just immediately positioned them among the mobile elite. And this rapid success in creating content, it earned them measurable industry recognition very quickly.
It did. By 2020, they were ranked on Pocket Gamer's list of the top 50 mobile game makers. And that just validates that their strategy of owning the tools and owning the content had propelled them to the absolute forefront of mobile gaming production.
So let's pause on the financial structure this created. Because this hybrid model, part software, part content, is so key to understanding their subsequent pivot, what was the revenue breakdown just before their major strategic overhaul using that 2020 context?
This metric is absolutely crucial to understanding the whole story. In 2020, their revenue was almost perfectly balanced. It was a 50-50 split, basically.
Really? That balance?
Yeah, it demonstrated a massively successful hybrid model. 49% of their revenue came from businesses using its software. That is the ad tech side, the B2B services we talked about, where they charge developers for optimization and advertising.
Okay, so just under half.
And the other 51% came from consumers making in-app purchases through the games they owned or published, like those from MZ or Lion Studios. They were fundamentally a technology company that was protected by a very robust consumer gaming division.
That makes the company incredibly resilient. I mean, if Apple's privacy changes hurt B2B ad spending, they still have the consumer revenue stream.
Exactly. And if consumer spending dips, the B2B software revenue remains.
But while they were building this gaming portfolio, they were simultaneously, as you put it, collecting the infinity stones of ad tech by acquiring the crucial tools for the entire industry.
That's a great analogy. And it started immediately after that KKR investment. In September 2018, they acquired Max,
Max, the in-app bidding platform.
the in-app bidding platform. Now, to clarify for our listeners, before Max, mobile advertising relied very heavily on a process called waterfalling.
Let's elaborate on that technical detail because it's fundamental to AppLovin's competitive advantage. What was the problem with waterfalling and why did in-app bidding solve it so effectively?
Waterfalling was a really inefficient serial process. Ad requests were sent to networks one by one based on historical pricing data.
So it was based on old data,
The old data. If a network offered a high price historically, it got the first look. If they didn't fill the ad, it waterfalled down to the next network, and so on and so on.
which left money on the table
Yeah.
and wasted time.
A lot of money on the table. And it often resulted in poorer quality ads. Max's in-app bidding just revolutionized this by introducing a real-time unified auction. All demand sources, Facebook, Google, AppLovin's own network, they all bid simultaneously in real time for every single ad impression.
So in-app bidding maximized the revenue for the developer in real time. It gave the app owner the absolute best price for every single ad slot. It's a massive jump in monetization efficiency.
Precisely. And the Max acquisition immediately came with key integrations and partnerships, notably with Adjust and the massive Facebook audience network, which just accelerated its adoption by major developers right away.
So once they owned the core bidding engine, the next logical step was protecting the user experience and the integrity of the ecosystem, which led them directly to the SafetyK acquisition.
That was the move in 2019. SafetyK is a software development kit management platform, an SDK management platform.
Why is that important? What does that do?
Well, every mobile app is a collection of various SDKs, tools from different vendors for analytics, for advertising, for crash reporting, and so on.
Okay.
A poorly coded or malicious SDK can crash an app, it can degrade performance, or even violate user privacy. So SafetyK was a really smart defensive acquisition that was focused on ad quality, performance, and stability.
So it gave AppLovin the tools to ensure that the ads running through their Max platform were high quality and safe. It protected their brand and their developer partners.
It was quality control for the whole ecosystem.
And finally, they completed the loop by acquiring the measurement and analytics tool that tied everything together. And they did this right before their public market debut.
That was the acquisition of Adjust, the mobile app measurement company, in February 2021. And this was the final piece of the full stack offering.
Because measurement and attribution are the holy grail of mobile marketing.
The holy grail. They tell developers exactly where their users came from, how much they cost to acquire, and how much revenue they ultimately generated.
So what was the comprehensive offering after the Adjust acquisition? What could AppLovin offer a developer that a competitor just couldn't?
They created this unprecedented, seamless end-to-end loop. They could use app discovery to help developers find users. They could use Max to monetize them as efficiently as possible through in-app bidding. They could use Lion Studios to publish and learn from their own content.
Yeah.
And then they could use Adjust to measure exactly how effective every single dollar spent and earned really was.
They became the comprehensive one-stop shop for mobile developer success. They controlled every single step of the value chain.
The whole thing, top to bottom.
So with the gaming arm robust, the ad tech stack complete, and the digital economy just booming post-pandemic, AppLovin was perfectly positioned to capitalize. And this brings us to their initial public offering in 2021.
The timing, as you noted, was just impeccable. They filed for the IPO in March 2021, and they were seeking to raise $100 million in the process.
$100 million.
And they were joining this parade of gaming and ad tech companies who were leveraging the acceleration of digital consumption caused by the pandemic. I mean, their 2020 sales had reached a whopping $1.45 billion.
And the actual trading day just solidified their sudden transition from a $2 billion private firm to a $24 billion public titan?
Yeah, on April 15, 2021, AppLovin began trading on the NASDAQ under the ticker APP. They started at $70 per share, which instantly gave them a total market valuation of approximately $24 billion.
$24 billion. To put that growth in perspective for you, in less than 3 years since that KKR investment in 2018, their valuation multiplied 12-fold.
12 times. It was pure, explosive velocity, and it was all fueled by their successful integration of ad tech and content.
And following the IPO, they didn't pause to celebrate, did they? They went into an even more aggressive consolidation mode, which was highlighted by two spectacular high-stakes market events, the MoPub acquisition and the Unity showdown. Let's start with MoPub.
MoPub was a significant strategic trophy. On October 6, 2021, AppLovin announced they were acquiring the mobile monetization company MoPub from Twitter for $1.1 billion.
$1 billion from Twitter.
The deal finalized in January 2022. And MoPub wasn't just another company. It was one of the internet's longest established and most massive mobile ad exchange platforms.
So why spend $1.1 billion from MoPub when they already had the Max platform? What did MoPub provide that AppLovin lacked at that point?
Two things: inventory and developer relationships. MoPub had a deep, entrenched developer base and just massive volumes of ad inventory flowing through its exchange every single day.
So it was about scale.
It was all about scale. Integrating MoPub into the AppLovin ecosystem meant instantly absorbing a huge established chunk of the mobile advertising market. It gave Max a much greater competitive advantage and put them in a much stronger position against rivals like ironSource and even Google's offerings. It was about solidifying their market share and ensuring supply.
That move solidified their dominance, but the true declaration of war against the competition came in August 2022, the Unity showdown. This was just unprecedented in its scale and its audacity.
It was an incredible move. It was reminiscent of a corporate takeover battle you'd read about in, like, the financial history books.
Totally.
AppLovin made an unsolicited, audacious offer to buy Unity Technologies, a major rival and the dominant development platform used by countless mobile games, for a monumental $17.54 billion of stock.
$17.5 billion of stock. That shows they were willing to leverage their massive public valuation to finance the deal, but the sheer scale of that offer is almost unbelievable. And the bid wasn't just about acquisition, it was about defining the market, because it came with a non-negotiable condition.
And that condition was the crux of the entire strategy. AppLovin's bid required Unity to immediately terminate its previously agreed-upon deal to merge with ironSource.
And ironSource is a direct competitor to AppLovin's core ad tech business.
Their biggest competitor. AppLovin was essentially attempting to execute this hostile vertical integration maneuver. They wanted to acquire the most important game engine, which is Unity, and simultaneously block their main rival, ironSource, from scaling up through that very engine.
So they were trying to achieve near monopoly status in the mobile development and monetization pipeline in a single transaction.
Exactly. It was a bid for total comprehensive dominance over the entire mobile development stack. And to make the bid more palatable to Unity shareholders and leadership, they proposed a collaborative management structure, not just a simple, hostile takeover.
Right. The proposal would have resulted in Unity's CEO, John Riccitiello, becoming the CEO of the combined entity.
Which suggests AppLovin's founder, Adam Forey, was willing to step back from that top job for the sake of market control.
So how did the market respond to this aggressive play? And what was the ultimate outcome of the confrontation?
Well, Unity's board debated it intensely, but ultimately they rejected the offer later that same month.
They rejected it.
They did. They cited that the AppLovin offer did not present a superior proposal to the strategic value they saw in merging with ironSource. So Unity chose to commit to completing their acquisition of ironSource instead.
So if we connect this rejection back to the overall competitive landscape, what does the failure of this massive bid tell us about the future of the mobile market?
Well, what's fascinating here is that the Unity showdown was a defining moment. It was a moment of competitive struggle. It signaled that AppLovin was willing to use every lever available, including its massive valuation and its stock as currency, to achieve market dominance.
And the rejection meant that the market would remain highly competitive.
Exactly. Bifurcated between the Unity ironSource entity on one side and the AppLovin stack on the other. And this failure, it forced AppLovin to rethink its entire strategy for achieving exponential growth, which leads directly to the immense strategic pivot we see in 2025.
And it's also worth looking at the nature of the offer, right? The stock-based offer.
We need to examine that.
Yeah.
While $17.54 billion sounds huge, offering stock meant AppLovin was highly reliant on its current and arguably inflated valuation holding up.
So Unity's board likely viewed that as a risk.
A big risk. They preferred the cash and stock mixture and the perceived stability of the ironSource deal. It just highlights the inherent risk in using highly valued public stock as currency in large M&A.
So the failed Unity attempt clearly didn't slow AppLovin's overall growth, but it did precipitate this massive tectonic shift in their corporate identity. Despite the success of their hybrid model, remember 51% of revenue coming from consumer games, they announced the Great Divestiture in early 2025.
This was the 180-degree turn. In February 2025, AppLovin announced they would divest their entire mobile games development business to focus exclusively and entirely on their core advertising software business, Max, Adjust, App Discovery.
Wait, I have to challenge that premise, though. Why would you abandon a revenue stream that represented over half of your income and had proven to be so resilient? Doesn't selling a business segment right as it hits peak performance look a bit like financial engineering, to juice the ad tech valuation ahead of that S&P inclusion?
That is precisely the analytical question we have to address, and there are several interlocking strategic and financial reasons for this drastic pivot.
Okay, what are they?
Firstly, valuation multiples. The market typically awards much higher valuation multiples to pure-play software and ad tech companies.
Why is that?
Because they're seen as having a higher margins and less operational complexity than running multiple game studios, which require constant content updates, massive marketing spend, and dealing with fickle consumer trends.
So they were cleaning up their balance sheet and their narrative for institutional investors.
That's exactly it. And secondly, the regulatory shift, the post-ATT world.
Apple's App Tracking Transparency Framework.
Right. ATT made user acquisition and data-driven marketing significantly harder for game studios. Operating game studios in that environment just became costlier, riskier, and less predictable.
But Apple and its platform provided the tools for developers to navigate this difficult new landscape.
And that's what they realized. They realized the value was in selling the shovels, not digging for the gold themselves.
So by focusing purely on that high-margin software core, they could generate cleaner, more predictable earnings, justifying a sky-high valuation. And they executed this sale incredibly rapidly.
With incredible speed. The mobile games development business was sold to a private company for $900 million.
$900 million.
And a specific key transaction within that was Triple Dot Studios acquiring AppLovin's publishing division, Line Studios, in May 2025 for $800 million of that total. It shows the significant capital they were willing to harvest from their gaming arm, signaling to everyone they were all in on ad tech.
Now, in the middle of this massive portfolio pruning, AppLovin showed that their ambition was far from diminished. They made another incredibly aggressive move into a major market opportunity, the bid for TikTok's U.S. assets.
This is the definitive indicator of their scale and ambition post-pivot. In April 2025, following the U.S. government's requirement for ByteDance to divest TikTok's U.S. subsidiary or face a ban.
Another immense geopolitical flashpoint.
A huge one. And AppLovin made a bid to acquire the company. They were ready to deploy the $900 million from the gaming sale, plus enormous leverage, to secure a massive piece of the world's most dominant short-form video and advertising market.
That's a company that has zero intention of playing small. They are betting their entire future on securing the biggest possible slice of the digital ad pie. And the financial results right before this pivot show they had already achieved stunning efficiency.
Oh, if we look at the specific financial metrics from their 2024 annual report, so right before the divestiture fully closed, the scale of their efficiency is just staggering. Their revenue stood at US $4.71 billion.
$4.7 billion.
You're right.
And the profitability ratios are what truly impressed the market, right?
Absolutely. They reported operating income of US $1.87 billion and a net income of US $1.58 billion.
$1.5 billion in net income.
But what's even more remarkable is the efficiency ratio.
Yeah.
They managed that massive scale and profitability with a relatively lean workforce of just 1,563 employees.
Wow. That ratio of net income to employee count is just. It's characteristic of a highly optimized, specialized software business, which is exactly the identity they were fighting to assume.
Precisely.
And the market rewarded this focus strategy with a stratospheric valuation, which became their market apex.
Massively. Barron's reported in July 2025 that AppLovin was valued at an astounding $123 billion.
$123 billion. That represents a peak growth trajectory, soaring from that $24 billion IPO valuation in 2021. This move just demonstrated the financial community's absolute belief in the pure-play, high-margin ad tech model. And reaching that $123 billion bracket guarantees a certain level of institutional recognition.
It secured them elite status. In September 2025, just months after the pivot and that TikTok bid, AppLovin was officially added to the prestigious S&P 500 index. They are also a component of the NASDAQ 100 index.
And that inclusion is the ultimate validation, isn't it? It signifies that Wall Street views AppLovin not as some volatile startup, but as one of the largest, most stable, and most representative components of the entire U.S. economy.
It's the top of the mountain.
So we have an S&P 500 company valued at $123 billion, a triumph of mobile data optimization. But as we know in the digital economy, aggressive data practices and explosive growth almost inevitably attract immense regulatory risk. We have to introduce the critical allegations that surfaced right around the time of their strategic pivot.
And it is essential here that we approach this impartially, stressing that these were claims made by a short seller firm, Fuzzy Panda Research, in February of 2025.
Right. And short sellers, by definition, benefit if the stock price falls, so their claims must be viewed in that context.
Absolutely. But the allegations themselves were severe enough to initiate government action.
Okay, let's detail those specific allegations. What exactly did the short seller firm claim AppLovin was exploiting within its sophisticated B2B infrastructure?
Fuzzy Panda Research alleged three major, very damaging issues that struck directly at the integrity of their platform. First, they alleged AppLovin committed ad fraud, suggesting sophisticated manipulation of attribution data to claim credit for installs they didn't actually generate, which would potentially inflate their success metrics.
Okay, and the second?
Second, they claimed the company illegally tracked children, which is a direct violation of U.S. privacy laws like COPPA. And third, and most disturbingly, that they served sexual ads to kids, representing an egregious failure of brand safety controls within their network.
Let's delve deeper into the technical mechanism of these allegations. When a short seller claims ad fraud, what specific kind of exploit are they usually referring to in a complex mobile attribution system like the one AppLovin runs?
The fraud allegations often target the gray areas of mobile attribution. This can involve sophisticated manipulation of attribution windows, where the time between a click and an app install is artificially shortened or lengthened to claim credit for what was actually an organic install.
Okay.
It could also involve things like click injection or click spamming, where false clicks are generated by non-compliant SDKs, fooling the system into believing the user came from a paid channel.
And for a company like AppLovin, whose entire pitch to developers is maximum monetization efficiency and honest attribution, these claims directly undermine the trustworthiness of their core products, AppX and App Discovery.
It strikes right at the heart of their value proposition.
And the claims regarding illegal tracking and inappropriate ads served to minors. That strikes at the regulatory core.
Absolutely. Global privacy laws, especially COPPA in the US and GDPR in Europe, place immense burdens on technology companies to protect user privacy, particularly that of minors.
And the sheer volume of data AppLovin processes through MoPub, AppX, and Adjust meant that maintaining perfect compliance across, thousands of games and networks must be a massive operational challenge.
A huge challenge. The allegations suggested that the controls were either inadequate or deliberately circumvented. And for a company that aims to be the undisputed leader in ad tech, this represents the absolute highest level of reputational and legal threat.
And that threat moved from just short seller claims to official government action, and it did so shortly after the market validated their massive valuation.
That is the ultimate convergence point of this entire story. In October 2025, just 1 month after their inclusion in the S&P 500, Bloomberg reported that the SEC, the Securities and Exchange Commission, was officially looking into AppLovin regarding their data collection practices.
The SEC.
The SEC's involvement elevates the issue from a private market spat to a formal governmental investigation into potential financial misrepresentations and data compliance failures that could affect every single investor.
So if we look at the whole picture, what is this convergence, the $123 billion validation side by side with the SEC probe? Tell us about the state of modern ad tech. What is the core conflict for you to understand?
The tension is immense, and it's deeply informative. AppLovin achieved the highest form of U.S. corporate validation possible, S&P 500 inclusion, a colossal market cap signifying its place as a pillar of the American economy, successful by every traditional metric.
Right.
Yet simultaneously, they are under formal investigation by the principal securities regulator over the integrity of their data collection and reporting.
It suggests a fundamental systemic issue in the broader ad tech ecosystem, doesn't it?
It absolutely does. Success on this scale, which is derived from aggregating and optimizing user data, often appears intrinsically linked to aggressive or high-risk data utilization practices.
The market rewards the scale and efficiency they provide, giving them that $123 billion valuation.
But regulators who are finally catching up to the speed of data collection are now demanding accountability and responsibility. The success narrative and the regulatory cloud are two sides of the very same coin in the digital age.
So AppLovin now faces this existential challenge of proving the legitimacy of the data engine that drives their valuation, all while under intense federal scrutiny.
Exactly. It's the ultimate dichotomy. A company that mastered mobile monetization now has its future dictated not by engineering success, but by legal compliance.
We've charted an incredible and highly illustrative journey. AppLovin moved from operating in stealth mode in 2012 through that geopolitical resistance of the CFI-US blocked Chinese acquisition and into its hybrid identity as both a powerful gaming publisher and the dominant ad tech giant.
That's right. And they spent years meticulously consolidating power through these critical strategic acquisitions, Max, SafetyK, Adjust, and MoPub, to create that seamless end-to-end mobile ecosystem.
And their moment of financial supremacy was just spectacular. A $24 billion IPO, an audacious $17.5 billion high-stakes battle with Unity.
And that massive 2025 strategic pivot where they shed their gaming portfolio for $900 million to focus entirely on the high-margin advertising core, this ruthless focus culminated in that breathtaking $123 billion valuation and inclusion in the S&P 500.
And the narrative of AppLovin is a perfect modern case study in tech consolidation, the intense efficiency demands of the mobile ecosystem, and the sheer velocity of capital accumulation in digital advertising.
But it also profoundly highlights the immense regulatory risk associated with operating a multi-billion-dollar business built on data collection, especially concerning user privacy and minors, as evidenced by those shirt seller allegations and the subsequent SEC probe.
The company mastered the technical aspect of mobile monetization, but its next challenge is entirely existential, proving, under the highest level of regulatory scrutiny, the absolute legitimacy and compliance of the data engine that allowed them to achieve that status.
They scaled faster than the regulations could catch up, and now the reckoning has arrived.
Which brings us to our final provocative thought for you to consider as you wrap up this deep dive. Think about the scale of ambition implied by AppLovin's aggressive bid to acquire the U.S. assets of TikTok, a platform defined by its controversial relationship with user data, and then connect that directly to the ongoing SEC probe into AppLovin's own data collection methods. What does this immense high-risk appetite imply about the risk tolerance and future strategy of the leaders in the ad tech space as global regulation tightens? Are they operating with the belief that they can simply acquire or scale their way out of any regulatory scrutiny, or are they attempting to acquire a platform large enough to eventually dictate the new rules of the game? Something to mull over until our next deep dive.